know, Pam, you had sent me a topic on balance sheets, things to look for on a balance sheet. Yeah, I can tell you one of the most interesting. So when we're doing recasting of financials, we're typically looking at the profit and loss, and a lot of times we ignore the balance sheet completely. But I can tell you that when you take a look at the balance sheet year over year, if you have a business owner that's telling you how great the business is doing, and then when you look at the balance sheet and you see under liabilities, you see shareholder loans, and that number keeps increasing year over year, then the business owner is putting money into the business. And if the business is doing really great, then the business owner shouldn't need to be putting money into the business, and that number should be going down, not going up. So that's one of the first things I look for on a balance sheet is, do they have a category of shareholder loans or, loans? And if so, is that number going up or going down? Because that can tell you a lot. Other things that can be manipulated on the balance sheet are your cost of your inventory, which will affect your cost of goods sold. And so if somebody is playing games with the inventory, then, their cost of goods will be up or down, which will affect their net income as well. So the inventory, I'll tend to look for the average inventory. What is it year over year? And if I see that there's, 200 one year and 500, or 200,000 one year, 500,000 the next, and then, 300,000, it's like, well, how much inventory do you typically carry? Why did it jump so high? What was going on in the business at the time? And sometimes the answers make sense. I mean, sometimes they just had a really good buy on something if they bought in volume and they knew they would sell it, so they just stocked up. So yeah, Kevin.
Could a business owner get in trouble with the IRS if they are manipulating those numbers with inventory and COGS just in order to reduce tax liability, or is that perfectly legal to do?
It depends on how they're doing it, but generally speaking, if they're manipulating the inventory, they're not, in a lot of businesses, they're not declaring it, which is problematic. I've dealt with business. I remember dealing with a manufacturing company. They actually were manufacturing, it was like a screw shop. They manufacture small parts. And so their whole concept was that, their clients would order these parts, and the setup of the machines took a long time and was more costly than actually the raw materials that went into making the parts. So if somebody ordered 1,000 parts, they would just create 2,000 and stick 1,000 of them in inventory. So when we go to sell the business, their balance sheet said they had $750,000 in inventory, and they were doing about $5.5 million in sales. But their warehouse, they were saying they had around 5 million in inventory. And that was a problem because yes, they're not declaring it, but also when you're looking for a buyer and you have that much inventory sitting on the shelf, that's almost a full year's worth of inventory. And some of it had been there longer than a year. People don't want to finance that inventory. And so you start having problems with your deal structure because maybe your business value is, maybe they have so much inventory that the cash flow is not sufficient to cover the debt service if they have to take out a loan to buy the business with all the inventory that's there. And so sometimes you have, especially on smaller businesses where the cash flow is a lot lower, you could have a business that has maybe 120,000 in SDE or 150,000 SDE, but if they have 300,000 in inventory, there's not enough. If they have to take out a loan, you can't sell that business for 450. You could try, but probably the 150 of SDE is not going to be sufficient to cover the debt service and give the person a reasonable living wage, depending on what part of the country they're in. So usually you have to structure that so that maybe 100,000 of inventory is included in the deal. You're selling the business for 250, and the balance of the inventory is on consignment, and they're going to pay the seller for it when they sell it. So there are just, when a business is inventory heavy, there are just different things that you have to do to try and structure that in a way where a bank is going to underwrite a loan and a buyer can actually afford to buy the business. So it can be a problem.